Hey everybody, welcome to another episode of the Notorious POD podcast. I decided I'm going to name it because I've used that name for a while. And I've got kind of a special treat today because I saw a post on Facebook from my good friend Keith Robinson. And he talked about sort of housing bubble and why he feels like it's not a bubble. And Keith is like one of the smartest guys actually in the industry, who's not an economist as far as I know, but because he's practical, I feel like his insights might be even more interesting. So with that, let me invite Keith into this mix. Keith, how you doing?
I'm good. How are you? Good to be seen.
Looking good.
Thank you, sir. I am not an economist.
Yeah, neither am I. Right.
Right. So, but in some ways, to your point, economists tend to believe that people act rationally.
Right.
And life has taught me that is inaccurate. So, perhaps I won't say more qualified, but
Right.
I pay a lot of attention to the economy, especially with regards to residential real estate for a long time.
Right. And for anybody who doesn't know, you are the Chief Strategy Officer for NextHome.
I am.
Which I believe is the #1 franchise in real estate. Is that what I heard?
We recently won the #1 franchise for franchisee satisfaction across all sizes and all market segments.
Congratulations.
So ranked against our peers. That's the award we're most proud of. It's they survey our franchisees independently of us. It's not one of those awards you can acquire. We know those exist.
Yeah.
It's one that you earn, and at the end of the day, I need a better phrase than at the end of the day, but at the end of the day, that's what we're rated on. We're a service business, and if our franchisees are happy, then we will inevitably be happy as well.
Hey man, it's fantastic. And hey, before we begin, since our mutual friend and your boss, I guess, James and his wife Katie just welcomed a new daughter, I figured we should give a little shout out to Ella.
Shout out to Ella. What's up, E-Train? Yes, I nicknamed her E-Train because James is about to get hit by the baby train.
Run over. Yeah.
Yes, he's about to experience lack of sleep, changing diapers.
I think we should. I think we should take up a collection as to what age over under Ella will have a horse, have a pony. I'm going to go with 5.
Oh, I'll take the under. I'll take the under. I'll take the under. I don't know at what age she'll be on a horse, but she will probably be on her own horse before she's ready.
All right. Well, with that said, let's talk about this post, man. This is a really great post, so I'm just going to see if we could display it real quick. Okay. So you wrote this April 26th, so about a week ago, and you called it a long economic post, and I laughed because, like, Keith, you know, long post. This is a couple hundred words at most.
It's not notorious long, but it's Facebook long. I like to warn Facebook when it's more than more than just a photo.
True. So if I understand the overall point that you're making here is that you don't think that there is an actual housing bubble going on, and you started talking about it because there's a 2,500% increase in people Googling housing bubble. Right, is where you began this with. How did you come? Yeah. So talk to me first about that. Like, how did you even sort of decide that you need to talk about this?
Well, there is a certain amount of buyer fatigue that can happen in a market that is as tight inventory speaking, massive buyer demand, very limited supply, appreciation rates going through the roof, buyers dealing with writing offer after offer and losing, and they start to fatigue naturally. Right. And what that can create is, well, this must be a bubble, right? This must be a bubble.
Right.
And in some ways, like, my answer to that after looking at it is it's not a bubble, and that's part of the problem, right? Okay. Like, I almost kind of wish it was, because then there would be an easier solution for these buyers that are out there getting their face kicked in, right? Mm-hmm. I know we think everyone in residential real estate wants values to go up and away forever, but that's actually not true. We prefer a more fluid market where if someone wants to buy a house and someone wants to sell a house, it's somewhat in the realm of in ratio. And this is the most disjointed we've had ever that I can find
Right.
from the standpoint of buyer demand and available inventory.
Right.
And
Right.
it's unfun for everyone in the industry. Yeah, sure, it's great if you're taking a listing tomorrow for the human being listing their home and for the agent listing that home, that's great. But they also have buyers on the other side that they're representing that are trying to buy homes and they can't. And so to me, when you see this spike in people Googling housing bubble, that's a leading indicator for buyer fatigue. And I wanted the people in my network to understand and have some data so that they can answer that question intelligently.
Now, so one of the things you point out is the savings rate chart, and I
Yeah.
hadn't really thought about. So talk to me a little bit about that. Like, why did you focus on that?
What I tried to do was there's something called recency bias, right? And that's whatever happened to us last, we think is going to happen to us again. And I believe there is a relatively significant amount of recency bias when we're comparing things in the housing market. People are comparing it to 2008, and that's a mistake.
Okay.
2008 and 9 is a very different recession than whatever the next thing will be for us.
Okay.
And so I tried to unpack some of the differences, and one of them was savings rate. People weren't saving very much money in 2008. It was more of a opportunistic real estate market. There was pretty healthy supply and demand, but healthy supply as well. And people were cash out refinance rates were higher, savings rate was lower, borrower quality was lower,
Right.
and you had people just acquiring more and more real estate because they could. And what I wanted to show was just a few. I didn't want to, candidly, I don't want to bore people with stat after stat after stat. You and I like that, but not
Sure.
everybody does. And so I wanted to pull out just a few differences to try to show it. One of them is personal savings rate.
Okay, so let's look at that personal savings rate.
Yeah,
Because you found this chart. I think this is from Bankrate, right?
Yep. Yep.
So
Now, and I'll
just
admit, there's
yeah.
some things in there that are different, right? Like, yes, there's some stimulus money in there that people didn't have in 2008, and that has caused an increase in the savings rate. That's legit. That is
Right.
something that's there that wasn't there before. But I don't, as someone who's looking at the, I don't really, this isn't political. I don't care about why. I don't care about how. I care, are people, do more people have more money in the bank than they did last time things got weird? And the
Right.
answer to that question is irrefutably yes.
Okay. So what am I looking at here? I mean, it looks like we're saying what? Is that 2009? 2000? Like, what is
2000,
this big spike? Like, when did that begin?
recently, right? Now, and
Yeah.
there are two big components to that. One is the whole country got put on pause to some degree. We couldn't
Right.
travel, we couldn't go out. Discretionary income, discretionary spending went down. That's bad for the economy, but good for the savings rate, right?
Right.
So you basically, no one could go do anything, and the government gave a lot of people a lot of money. So
Right.
those two factors put a dramatic upward pressure on the savings rate. It's not it,
Right.
but it doesn't matter why, right? The simple fact is
So
a lot of
I get,
people have more money in the bank.
yeah, I guess what I'm asking you is, again, I'm having maybe it's just this chart, right?
Yeah.
It's a little hard for me to kind of see, like, is this spike all in 2020? In other words,
Yeah.
because from the chart, it almost looks like it began in 2019 to rise.
Yeah. It did start to rise in 2019. Incomes were going up. So it was slightly pre-COVID. You can
Right.
see the savings rate starts to dip, and then it starts to trend back up, and it's pretty healthy. That, I'm not a chart analyzer, but
Right.
what you look is for long periods of a sustained rate that sort of creates the floor, right?
Right.
And we saw an increase in savings over time, people putting money away and a gentle glide up. And
Right.
then the spike really starts when pandemic hits, discretionary spending goes away, and stimulus money starts coming into people's bank accounts.
Now, the thing that I guess I'm wondering is, shouldn't this rate dip, though, if you are buying a house? Right? In other words, like, okay, so everything you said is true. We're not going out anymore. It's stimulus checks. But really, stimulus checks were like $1,400, right? I
Sure.
mean, we're not talking $14,000, right? So, some of that, but okay, we're not going on vacation. There's no, trip to Disney. So now I've got more money in the bank, but I want to take advantage of that and buy a house, right? Because
Well,
we've
let me back
seen,
up.
yeah, go
Yeah, let
ahead.
me back up one step though. Like I know $1,400 doesn't sound like a lot of money, and a little bit of this is the law of small numbers. But because we're not very good at saving as a nation, if the whole nation put an extra $1,400 away, you're going to start to see a big
Sure,
spike, right?
sure,
So that
sure.
component
Yeah,
thing, there's a little bit of chartology there, right?
yeah. What I'm trying to understand is, okay, so granted we have more savings in the through the COVID period, right?
Yep.
But what we've also seen is buyer demand has been through the absolute. I mean, it's just been insane, and we know
Correct.
that we have had enormous numbers of transactions. I think Zillow came out and predicted something like 6.5 million transactions for this year.
Mm-hmm.
So wouldn't that suggest though that the savings rate should actually drop because people are spending their savings to buy houses? Like, are you seeing that at all?
In theory, yes. And I don't have data point with me to back this up, but now it's something I can dig in on for my next not long by Facebook standards, but or by Rob standards.
Hey, man, anytime you want to write a long post, I have a blog.
I'm good. That's my idea alone. Um, you still have people that we have way more people who want to buy a house than homes that are available.
Right.
And that means all of the people who can't, though, yes, there are a lot of transactions that are happening. There's a huge population of humans who are keeping their powder dry for the house they want to buy.
Mm.
And they
Okay.
aren't taking those dollars. And now this is anecdotal. I don't have, this is just me applying logic, but they're not going and buying boats or new cars because they're still in the process of wanting to buy a house. And so that means they're keeping all that powder dry for that housing transaction. Now, if
Okay.
buyer fatigue goes too far for too long and people go, man, forget this, I'm just going to rent for a while, it's too expensive,
Right.
then in theory, most people will not keep that capital in their bank for
Right.
24 months. They're going to probably
Right.
go buy some other things.
All right. No, I mean it's one of those things. Like, yeah, it kind of makes sense, but I'm like that's why I wanted to have a conversation with you. When I think about it, like, does it really make sense? Because we are seeing this massive demand. Yeah, so there's some of that. But the other one that I wanted to kind of focus on was this other chart to the left: housing starts
Yeah.
and household formation. Like, where did you find that? Because this is an area I've been focused on for a real long time, man.
The
So
household formation. Yeah. So you and I can
yeah,
dig in on this a lot, right?
yeah,
And some of this is, well, let's do the housing starts first because that's an
okay,
easier one. I think
yeah,
you and
it's
I are
way
gonna
down. Yeah,
yeah, we're gonna have more thoughtful debate around household formation, right?
yeah,
So housing starts are way down. Bunch of factors for that.
mm-hmm.
You've got, I think builders learned their lesson in 2008 and 9. Historically, they were really comfortable with this sort of boom bust mentality. They were
Mm-hmm.
massive consumers of risk. They figured it would always come back. Then 2008, 2009, they're like, whoa, that really hurt. Let's never do that again. So they
Right,
were more conservative than they've ever been.
right,
You've seen this huge spike, not only in lumber and other construction costs, also labor costs are exploding as well. And so what builders are saying is, if I don't want to go crazy because I believe over the next 18 months, cost for lumber will go down, cost for labor will go down. These
mm-hmm.
other expenses will be compressed and property values are going up. So I can actually make more money by building slower. I know that sounds backwards, but new home builders, in my opinion, have decided they can make more money by building slower because the cost side of the equation should come down as more people, more trades people go back to work.
Mm-hmm.
Lumber starts to normalize. These other materials costs start to normalize,
Right,
and the properties will have homes that they could have sold today will be worth more a year from now when they come to market.
okay.
So that's why we're seeing, in my opinion, the big short on housing starts.
Okay, but housing starts is a reliable data piece, right? The piece
Yeah.
that the household formation though, this is something that I've been like
when it's
arguing with, and
fuzzy,
you and I have
and
talked about it for
you
years now,
you've
right?
had we've had
Yeah.
bourbon and debated this before. Now we're just going
Correct.
to do it
So
without bourbon.
where's that data
Okay.
from, and how do you interpret that?
What? Okay. So the, what there's real data points and then there's mystery data points. The real data point is the millennial generation is the largest generation in the history of the United
That's
States of America.
correct. Right.
Not because of familial birth rates, people are having fewer kids, but you've got a lot more people, so that even though they're having fewer kids, the millennial generation is the largest.
It is definitely the largest. Yeah.
And they are entering their prime earning years, which is when you tend to see household formation.
Right.
And so the big debate, and you and I have had this before, is well, millennials aren't going to buy houses like the previous generation, right?
Okay. Yeah. I maintain that unless I see different data. Yeah.
Well,
But so
and
let's take a step back. Let's take a step back.
we could both
The,
be right. Yeah. Okay.
let's take a step back. The specific question I had was the way that, like the economists and like Census Bureau and others define household, right, is by head of household status. It's not necessarily by family or marriage. That's why I was wondering. So you could have this huge spike as, people kind of move out, and get their own apartment or whatever. In other words, some 30-year-old guy, some 30-year-old woman, like, okay, I'm now head of household. So that's a household, right?
Yep.
But it's not a family. They're not getting married because marriage rates and birth rates are still way down. So I was just wondering if you knew whether this was
what
family
I
or
don't know
household.
the specific chart, right? But if you look at the demand side, we agreed earlier that the demand side of the residential, what looks through my lens, household formation means people wanting to buy a household, right? That's that's my personal like
Yeah.
what I think about every day
Yeah.
isn't how we define household. It's are there more people that are going to want to buy a house
Right.
over the next 24 months?
Right.
And I agree with you, marriage rates are down. I agree with you, birth rates are down. I agree with you also that people are forming households later in life and buying households later in life. So there is this delay. Some of that's a hangover from the Great Recession. Some of that is because of life and a desire for freedom and flexibility. But what I remember hearing a decade ago was we're in huge trouble. These millennials don't value home ownership. They want freedom. They want flexibility. They want the ability to travel. Their gig economy, we're all the things, right?
Yeah.
And so far, I don't think that's true. I think this big spike that we have in demand, some of it is pandemic related, right? I'm going to be working from home forever. I didn't have a home office. I'm going to need a home office. That's a piece of it. But I think a lot of it is these first-time home buyers coming into the marketplace to acquire their first home.
Right. Okay. Yeah, I mean, I guess we'll see because I'm real curious about that.
Well,
but I
tell me
guess
why
so.
we agree. If we're both on here agreeing, that's not interesting.
Yeah, no, it's. I don't even think it's a matter of agreement or disagreement. It's a matter of speculation because, like I said, I've just not seen enough data around this. Right.
Where do you think this? Now I'll get to take over your podcast, kind of like it's
Please,
mine.
yeah.
Where do you think this humongous spike in buyer demand is coming from?
So I have a theory around it, right?
Yep.
And I've actually tasked Pedro, who works for me, to see if what he could find out. My feeling is there's a lot of investor demand, right? And there's no real good data around this. In fact, I'm trying to speak to somebody from John Burns Real Estate Consulting about this because they've studied sort of investor activity. And they did a report recently where they said roughly 20% of all purchases historically have been investors.
Okay.
But the way they define investor is like, everybody, right? Mom and pop,
Sure.
All the way up to, BlackRock, right?
Yep.
So this is maybe, so let me try and arrive at this by asking kind of questions because you're much more closer to like the ground, like what's happening on the ground, with talking to your franchisees, your brokers, your agents. Okay, we know that in a lot of cases, we're hearing these horror stories of, nice young millennial couple. So let's even take the millennials who are married and they're having
Yeah.
their first babies. They're like, okay,
Yeah.
it's time to buy a house, right? And they
Yep.
go, and bid on a house, and they offer 40,000 over asking, all conditions waived, and they get outbid,
Yep.
right? By some cash buyer with seemingly, a deep pocket, like unlimited funds, right?
Mm-hmm.
And they're buying these houses that surely will not appraise. Do you know what I'm saying?
Oh, yeah. So, all right.
Like the
I'll
comps
unpack
will
that.
not support going
Mhm.
60,000 over. Like it just will not support it, right? We've been hearing. So first of all, are we hearing this? Is this national?
Uh, yes, we're hearing this. The dollar amount varies market to market, right?
Mm-hmm.
Sometimes it's 60 over, sometimes it's 160 over, sometimes
Right.
it's 16 over. We are seeing people constantly overbid. That is true.
Right.
We are seeing people who are that I don't have any data to back this up, but anecdotally, there are more cash offers than normal, though not maybe by a dramatic percentage.
Mm-hmm.
Uh, I think what we're seeing is there are more offers, period. Which means there are more cash offers, period. I'm
Period.
not sure
Right.
the percentages are different.
Right.
And then I also believe that the willingness to let the value be defined by an appraisal is more of a how to write a winning offer strategy for some folks than it is anything else, right? So
Mm-hmm.
if I write the biggest number at the top, there's a better percentage that I will win. If it doesn't appraise, well, then we're going to have to renegotiate anyway, depending on the terms of the offer and everything.
Right. 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 So so this again, I have no data, I have no proof,
Yeah.
and if anybody's listening, if they have any data, I would love to hear from you, right?
And I would love
But
to
I
hear
just
from you.
Yeah, and because I just wrote a post about this. I have this gut feeling that I think what we're seeing is activity of financial investors. Okay.
So here's my question, though.
Yeah.
I personally believe no one can time the perfect day at the top, right? But I think most people would agree that over the next, say, 12 to 36 months,
Yeah.
we should see a retrenchment in prices in residential real estate, or at least a leveling off.
I'm not sure. We
Okay.
should, but so here's my theory, right? And again,
Yes.
I have no backup for this, or I
Okay.
could try and find little pieces, but
Yeah.
I don't know how convincing it'll be. Okay.
Okay.
It goes something like this. We were having a really hot sellers market, but it was kind of like a normal super hot sellers market in 2019. First 3 months of 2020 was just like it was on fire, right? I mean, every agent, every broker I talked to back then was like, "We're having the best quarter ever. This is amazing," right?
Everybody.
You
Yes.
know,
Us
it
too.
was going right. It was going really, really well, right?
Mhm.
And then COVID hits, and for about 2 months we saw this like dramatic dip,
Yep.
right? And it's because everyone's freaking out. Everyone's like, we don't know, like we might all be dead, right? I mean, everyone's like, we have no idea. Obviously we can't go anywhere. Everything's locked down. That whole thing. But then very, very quickly, we start seeing the market bounce back with this like sharp V recovery, right?
Yeah. Quick, but
Go
not
ahead.
both sides of the market. The buyer side
Yeah.
was willing to consume risk to go out
Absolutely.
into the
Yes.
pandemic world and
Yes.
try to find their next home. The
Yes.
seller side said, I'm not so willing to let a bunch of strangers walk through my home. So that's part of
Exactly.
our supply side
Exactly.
problem.
And they retrenched, right? So yeah,
Yeah.
it's like new listings are way down,
Yep.
but buyer demand is way up, bro.
Mhm.
And then I think as we get past the summer, right? I think we saw this insane run up, right? And what occurred to me was this, right? Some of the smartest people in the world in terms of finance are these hedge fund guys, and I speak to some of them, right?
Mhm.
And some of these guys, as I put in my post, like one of my friends was like, yeah, he took all of his liquid assets and put it into Bitcoin and crypto, right?
Yeah.
Now, this, he can afford it because he's got a bunch of other assets as well, and I get it. But again, these are guys who manage
Well,
like
that's a great story,
multi-billion-dollar
but
hedge funds.
that makes for a great story. But my guess is he did not put all of his liquid, probably a
He
lot.
said liquid assets, so I don't know what
Yeah,
that means. So
yeah,
maybe he
but
didn't liquidate his stocks, and
sure, sure. Yeah,
but
but
maybe yeah, because it's also somebody that you and I both read and follow is Ray Dalio, right?
yep,
Who
yep.
scares the living shit out of me like every time he writes something,
He usually doesn't have exciting positive news. Yeah,
right? But he's been talking about cash is trash for a real long time. He's been talking about
sure.
negative bond yields, like
Yep.
so. In any event, so he took some of his and put it into Bitcoin, and I'm like, well, why? And his so obviously his answer is I think Bitcoin's going to zoom and it's going to take off and whatever. But the unspoken language there is that he basically doesn't think that the dollar or any fiat currency, which is pretty much all the currencies in the world today, right?
Mm-hmm. Mm-hmm.
He's basically projecting a devaluation of currency, which is why
Yes.
putting it into Bitcoin. Now, that's an individual, but that
Yeah.
individual manages a hedge fund. And so I'm looking at some of these funds and I'm going, okay, where
I
do you
hear.
park your money?
Yeah, I hear that. I do. I think hedge fund individuals usually want these outpaced returns, and they're looking for
Correct.
arbitrage. Right?
Correct.
That's the magic word.
Correct.
If I believe that the dollar is going to get wonky, where do I get a better arbitrage? This sort of newer thing that's pretty volatile, but will have upside if the dollar gets weird, called Bitcoin and or crypto,
Right.
or a new hot real estate market that's been on a 10-year run up. I just don't see them perceiving. Historically, hedge funds stayed well away from holding real estate as a real
Correct.
asset.
Correct.
It took 2008 for them. They were like, "Whoa, we never really wanted to. We don't want to deal with busted pipes and renters and all." They liked mortgages. They liked paper. They liked
Correct.
holding paper.
Correct.
They didn't like holding hard
Correct.
assets.
That is true. Right.
We needed the most draconian drop in residential real estate values in our generation, anyway,
Sure.
for them to go, okay, I guess it's cheap enough. It's worth the arbitrage.
But even then, they didn't really go direct, right? What they did instead is they put money into REITs. So, the Black Rocks and
Yeah.
Invitation Homes and some of these publicly traded REITs, they saw the opportunity, like, okay, we know the fund guys, they don't want to manage houses. We're willing to
Correct.
manage houses. So let's go raise enormous amounts of money and then go buy 25,000 single family homes, and then we'll manage it.
Right.
We'll be Wall Street landlords. But the folks who are
See, I'm on the
investing in
other
those,
side. I
what's
think
that?
it's more likely that those folks are part of these inventory solution. If I was sitting on 25,000 homes that I bought in 2008, 9, and 10,
Right.
I would be talking to my partner saying,
Right.
look,
But here's the
it's
thing.
going to keep running, but I don't know
Here's the
for how
thing,
much
though.
longer.
So let's say you did that, right?
Yeah. I got to put that money somewhere.
Right. Where are you going to put it?
Me personally, okay, if Keith had a hedge fund.
If Keith had $1 billion, right?
Yeah, by the way, anyone listening, if you want to float me a bill,
Yeah.
I promise we'll get rich.
Or rather, it's you have $1 billion worth of real estate, right? And
Yes.
you're a institutional operator, right?
I would be liquidating residential,
Okay.
shifting it to commercial, because I believe
Oof.
this new work from home experiment.
Oof.
You don't like it?
Okay.
Why?
It feels real risky.
More risky than Bitcoin?
Yeah.
I don't. I think it's pretty safe to say there will be less demand for. We have a supply overage in commercial real estate, and demand will go down. Not massively, but I believe this work from home experiment that we've done over the last 18 months is going to have downward pressure on the demand side of the equation. Certainly better arbitrage in the commercial side than I personally see on the resi side.
Okay. No, I think it's,
no one's giving me $1 billion.
Yeah, I know, right? We're totally speculating if we had $1 billion.
Yeah.
Look, the reason why I don't think I would do commercial is because I don't know that like a lot of commercial is going to survive. Right. Like, for example, there's a lot of speculation that something like 2/3 of restaurants may permanently go out of business.
I guess that's my point. Is I would be taking my resi and liquidating.
Right.
At some point, you're going to see the pain in the commercial space where it makes sense to buy back in.
Okay. At a low enough price, you mean? Yeah.
At a low enough price. So I'm not saying I do it all today, but we're sort of singing from the same hymn book,
Yeah,
which we
yeah,
often
yeah.
we usually debate timing. You think the world's going to end tomorrow, and I think it's
Oh,
going to
I
be a
don't think the
little.
world's ending. I
No,
just
I
wonder
know,
what's
I know,
happening.
I know. We
But yeah,
usually
no, I
debate
get,
what's
I
coming.
get. But so that's if you're an operating fund. You know, that's what
Yeah.
if you're a BlackRock or Invitation. What I guess, my speculation, and again, I have no proof. No, there's been no data, and I'm searching for it.
I don't have
Is
any.
not just the hedge fund guys, but some of these very high net worth individuals, family trusts, like some of the quote smaller funds, maybe they have 10 million, 20 million,
Right.
right?
Right.
Which to us is like, holy shit, that's 10 million, Like, where's my Lambo?
Right.
But, to investors, like that's a small fund. That's a really tiny little family fund.
Yes.
Those guys might have been in bonds because they're not looking for 1,000x. They're not looking for this huge upside. What they're looking for is, how do I preserve this capital, right? So
Yeah.
those are the funds that would have been invested in bonds, corporate bonds, AAA stock. Those would be maybe treasury bills, and they have these financial advisors. Maybe they're not hedge fund managers, but they're pretty smart. They know what they're doing,
They see the
and they're
market,
doing
yeah.
diversification. They're doing all that. If all of those people looked at the fact that we printed something like 35 to 65% of all U.S. dollars in existence were printed last year.
Now we're going to agree at volume, right?
Right.
We've printed money at a level that's unknown. That
Unknown.
tends to create inflationary pressure.
Correct.
If
Correct.
you have inflationary pressure, real estate's a great hedge.
Exactly. That's
Yes.
kind of what I think is happening. So I don't know that it has anything to do with family formation. I don't know that it has anything to do with, any of that. I mean, I think we are seeing some impact of interstate movement, right? So like California movement of Nevada,
Yep.
like the
Net domestic
scourge of red states is basically
Yeah.
Californians, like,
Net domestic migration
yeah,
for
yeah.
California is at its lowest level that it's ever been.
But
Yes.
so I feel like there's something at work there. But even then, I wonder, like, unless you're selling a house in California that you've owned for 20, 30 years, so you've built up this enormous amount of equity, are you really
Sure.
moving to Austin and paying cash 700?
No.
I don't know, but I bet there's some of it, right?
Those. But
I bet
what
there's some of it.
my guess is
Yeah.
the increasing cash offers, there are more what I'll call quote unquote normal buyers that are actually looking like investor buyers. So
Really?
if yeah, well, more than normal. I won't say more than, I'm not saying that's all of that, but I'm
Right.
saying that's some of that. The devil is in the details
I
of
can see
what
that.
percent,
Okay.
right? Because if I have a bridge loan, which people are taking, basically the fear is I don't want to sell my house because I might not be able to buy a house.
Right. Right.
So buyers with means are focused on identifying and securing the upleg property before they let go of the downleg property.
That's right.
And they're doing that by getting their offer as close to all cash as possible.
Right.
If they have enough equity, they might be able to do a HELOC to buy that house in Austin for cash and then sell the California house. Or if they could go and secure a bridge loan, then they might feel comfortable writing an all cash offer, even though they really are going to secure financing during the purchase or immediately after the close.
Right.
So there's more of that. The question is, how much higher over 20% investor offers are we?
Yeah. I mean, so the reason why I feel like there's probably some of that, but the reason why I feel like the biggest impact might be from these financial investors. And let me distinguish what I mean by that. They're not real estate investors. Right? In other words, when we think of real estate investors, we're thinking of people who want to become landlords, who want to rent out their property. When I say financial investor, I mean literally people do not care if they rent that house at all. All they want to do is just take
money.
Yeah, they're like, I own $1 million worth of treasury bonds, and I don't want it
It might be interesting to look at, and I'll do it right after. See if we can even this data point. I mean, has there been a massive influx in investment in residential real estate REITs, right? Because most REITs are commercial. There's not very many resi ones,
right?
And the commercial ones, I would imagine, are not seeing a dramatic
They're
influx.
not doing well. Correct.
Because even the family funds still don't love the idea of holding real estate as a hard asset.
Mm-hmm.
No one really loves that conceptually.
Nope.
Because if you had a bunch of properties in Dallas and your pipes froze, like you're dealing with something you don't want to deal with historically as an institutional level investor.
Right.
And so, yeah, maybe it's the time to start a resi REIT. I just go back to
Yeah.
tell me how they're seeing that as an arbitrage player. Maybe we're missing each other.
No, we're missing each other. I'm saying it's not an arbitrage play. I'm saying,
I'm parking
and
my
it's
money.
not necessarily even a REIT. I'm saying, let's say it's just a family trust, right?
Yeah.
Family trust, they have 10 million, right?
Mm-hmm.
It's a good amount of money, but it's not REIT money. You know, it's not billions, right? And like the 10 million was invested in equities and bonds and whatever, and then you have some gold bars, whatever, right? And your advisor comes to you and says, "Listen, we need to get out of bonds. We need to get out of bonds. We need to get out of cash, right? Because inflation pressure, blah blah blah. You already own your home outright. You have, let's say, 2 other real estate investment properties. That dude's going to be telling the trust, the family, I think it's time to park your money in real estate. And you know what? It doesn't matter because we're going to pay cash, right? So we don't care about appraisal, right? We don't care about cap rates. We don't care about rental rates. We don't care about any of that because all we're trying to do is to park your money someplace that's going to outpace inflation. Last year, dude, real estate went up 14% year over year.
Yeah.
Right. So inflation is like 2, maybe 3. Mm-hmm. So if you're looking at 2021 saying inflation is going to be like 8, you know, like that's a pretty decent place to park your money. I have a feeling that's what's driving this.
I don't, only because of
the
illiquid nature of residential real estate. It's hard to get out of, right?
Is it that hard?
It is.
Has it been that hard the last 5 years?
It is hard compared to owning a REIT. It is like compared to it's hard. Well, I mean, bonds have a set duration, right? But they ladder them in and ladder them. So they know, right? So, but they're not they're not used to, they want to be able to make micro moves, quick pivot moves. And you can't do a quick pivot move if it takes 30 days to liquidate, right? 45 days to liquidate. In the financial world, that is a myriad of lifetime 45-day hold.
Yeah.
Why not buy a real estate stock or buy it into a resi REIT that gets me, I can park my money. I agree with you. There are funds that are worried about inflation that are trying to find ways to park their money in residential real estate because it's a great inflationary hedge.
Right.
I'm not willing to go all the way to they're going out in mass and acquiring real estate as a hard asset. That's a pretty big step. That if they weren't willing to do that in 2008, when it was really easy to see the arbitrage story there and say either the world's over, or we're going to make a lot of money holding these assets.
Well, we know in 2008 a whole bunch of small investment, the family trust, they did do that, right? Like, I know people who sold like an apartment building in Boston and then bought 7 homes in Las Vegas because it was so cheap, right? Those guys are like multiple millionaires
and
now.
They made a lot of money.
They made a shit ton of money, right?
But they made a lot of money buying at the bottom. I don't think most
and they were operating, right? They were getting rent. They actually became landlords, right?
And I don't see most family, not in mass. Do I believe there are some? Yes, 100%. But I don't think most people see this as the bottom. They see it as at or near the top. So I don't get that arbitrage. I'm worried about inflation.
Yeah, I don't see it at the top at all, man.
Well, okay, but like
I don't see it at the top at all.
What I mean by top is I don't think we're going to continue to see 14% appreciation.
Sure.
Nationwide.
Sure.
Sure. So it's going to go down by 30% next year and maybe another 30% the year after that.
To go down, you mean the rate of growth?
14 to 8% appreciation in residential real estate, 8 to 5, some sort of normalizing of appreciation in residential real estate, right? I believe that's what will happen.
Okay.
If you really think it's going to be double-digit appreciation again for the next decade, then
I think part of it for me is, as you showed, we haven't built enough housing since 2008.
Totally
Right?
agree.
No question about that, right?
Zero
Okay.
question. And
Since
boomers are
that point,
living longer. Boomers are
right,
living longer, holding on to
right,
their homes. So
right,
that's
right,
part of the issue.
right,
Yeah.
right. So when the market started to come back, say in 2010 or
Hmm.
so last 10 years or so, and maybe you have the stat, I haven't looked it up. What has been the average sort of housing price appreciation? Because I
I don't
have to
have it
think it.
in front of
No, here's
me,
the thing.
but
I have
yeah.
to think it was higher than inflation.
Well, yeah, inflation was like zero.
Inflation was like zero, or maybe one, maybe two,
Very
right?
low. Right. So
Very
yeah, it was
low. But
definitely
housing over the last 10 years because of the lack of supply, I feel like it's been around, maybe 4, 5, six
maybe
percent, something
even more.
like that.
Yeah, I think even a little
Right.
higher personally.
Right.
Yeah.
So I guess what I'm looking at is okay. Well, that was before we printed $700 trillion, whatever we done, right?
Yeah.
So just
Yeah.
going forward, I feel like you know what if I just say I'm not going to rent to anybody. I'm literally just going to buy this house in Austin for 700,000. Will not appraise. It's a ridiculous price. Every one of my agents are like that. You're paying too much. That's ridiculous, right? That
Yeah.
is,
Yeah.
and I go, yeah, but is it going to be outpacing inflation? Is it going to go up by 4%, 6% versus inflation, which might be at 2? Now, here's the thing. Let's say 2021 comes and inflation's at 8.
Sure.
Dude, there's no way in hell housing doesn't appreciate more than that.
Yes, I think eight
Right?
by 2021. Again, as you and I, when we disagree, it's usually on pace,
Right.
not on directional.
I'm just
So
saying, like, because the supply of housing is still low, and to your point, builders aren't building fast because lumber prices, all these other factors. So it's like
mhm.
whatever house you buy today, if inflation's at 8, I feel like then house price will go up by 10 or 12, or you know what I mean, like above whatever inflation is. Is all I'm
Yeah,
getting at.
I agree. There's you can't move that one dial though and have it only move one other dial, right?
No, I understand. Right. So
If
everything's
inflation
getting more
goes up
expensive.
to 8,
Yeah.
that also probably means interest rates are going up. If interest rates are going up and home values have appreciated for 2 more years, how many buyers have gotten priced out of the market? The buyer
Right.
pool
Right.
now
Right.
inches
Right.
puts downward pressure on appreciation.
Right. Right.
I I think that, in my opinion, it's unlikely in mass that institutional money is buying real estate as a hard asset.
Interesting.
I
Okay.
think they are trying to find ways to park money in real estate, whether that's buying real estate centric stocks, residential REITs,
Mm-hmm.
those types of investment vehicles. I
Yeah.
still think that, mostly
Okay.
because they do tend to be opportunistic, even if they're trying to find a park, right? This really smart guy that you talked to didn't go buy a bunch of real estate stocks because they've appreciated a lot in the last decade.
Yeah.
He went
Yeah.
and did the Bitcoin play, right? Or some other, they're going to look for an arbitrage market or an emerging market that they think will also be an inflationary hedge
Mm-hmm.
over
Mm-hmm.
something that ran up for a decade.
Yeah. All
But
right.
if I really knew, I'd be selling my newsletter
I know,
for
right?
$100 million a quarter.
And once again, neither of us are economists.
Nope, nope.
Neither of
And
us are
neither of us are
investment
independently
managers.
wealthy or retired. So we
So
can't be that good at this.
right. So let me finish because it's already been a great conversation. Let me finish by
Yeah,
one thing that you did mention in your post, which was you did not think that was like a foreclosure wave coming
Oh
from
yeah,
this.
yeah, yeah.
Now,
I get this a lot. Now,
yeah, I have
right.
heard opinions because of the eviction moratorium and the foreclosure, moratorium. That once those are lifted, we're gonna see foreclosures, a foreclosure wave coming, which will help with supply. Blah blah blah. Tell me why you don't think that's gonna happen.
Okay. There will be more foreclosures because you can't have more than nearly zero. Okay. So when I think people say wave of foreclosures, I think they're harkening back to 2008 and
Mm-hmm.
2009.
Mm-hmm. Yeah.
And the data just simply doesn't support that. If you go look at the foreclosure filings prior to the moratorium, they were very low.
Mm-hmm. Mm-hmm.
And if you go look at the foreclosure filings in 2008 and 2009, they were very high, right?
Right.
Like when I get the most aggressive that I can get, I get to about 25% of the foreclosures filings that we saw in 2008 and 2009.
Mm.
Well, why?
Okay.
Well, Unemployment's really bad. That's true. That's a fact. Yes, unemployment's really bad, and people who are unemployed can't afford to pay their mortgage. That is also true. I'm no economist, but I believe those two things are true.
Right.
But what we see is the savings rate higher. More people have more cash than they had then. The borrower quality
Is
that
higher.
of the loans that were made in '06 and '07, right,
Yeah.
prior to '08, '09, and 10, borrower quality higher.
Yeah.
Um, Equity position higher. There
Yeah.
were more properties underwater in 2008 and 2009 when it started. There were
Yeah.
more properties underwater then, significantly more than there are today.
Yeah.
So, do I believe there will be an increase in foreclosures? Yes. This wave concept that people talk about, if they are saying it's going to be like '08 and '09, I couldn't disagree more. If they're saying that there will be more foreclosures than we had in 2017 and 18 and 19, sure, I agree with that. But it's not going to look anything like 2008, 2009.
Right. So maybe a swell, not a tsunami kind of situation.
Correct,
All right.
correct. It's all
That's what I
about,
think about.
what do you mean by wave, right?
Right. Right.
And I don't think there is enough to solve the supply side issue. What I think is we're going to see a big increase in what I refer to, because I'm clever, going to see a big increase in stressed sales,
Mm.
not de-stressed sales. There
Okay.
will be people who are selling because they have to, because they're unemployed, because the moratorium's been lifted, but they've got equity,
Right.
right? So, and even if they haven't made their payments for a year, they still got equity because in the last year, to your point, the home has appreciated 14%, some places
Right.
more.
Right.
So it was a great financial decision for them. They're going to make more money. So you'll see an increase in stress sales, people who are being forced to sell, which doesn't feel great and they aren't going to like it. But it won't be your classic de-stressed sale where it's held by a bank. Now, if you
Right.
want to hypothesize that we're going to see an increase in stressed sales, totally agree. And that one could be a big one. I just don't know if it's big enough to solve the dramatic shortage of inventory we have.
Right. Right. Cool. So let's final thoughts. Like, what are you telling your brokers and agents in light of all of this? Like, so
Okay.
if people are
I
listening,
personally,
watching
yeah,
this, right? Our brokers and agents, what do you tell them?
I I tell them, I start with, I'm not an economist, but I believe that buyer fatigue is going to be a primary source of what normalizes this market more than the supply side of the equation. So demand is actually going to come down because of rate increases and because of people being priced out of the market. And so I'm paying a lot of attention to what interest rates are doing and how fast are they going up and how much are they spiking. I'm paying attention to inflation because that's going to put more upward pressure on housing price, like we already talked about. And
Yeah.
every time those two things go up, some buyers drop out of the market. Some buyers decide that they can't afford it.
Yeah.
And I feel horrible for those folks because in my industry, I want everyone to buy a house, right? That's
Sure.
what I want. I
Sure.
want more buyers, not fewer. But I just don't see a solution, a 18, 24, 36-month solution to the supply side problem. So that would mean then that demand has got to come down a little bit. And that comes down through rates going up, property values reaching a point where buyers just can't afford to
To
enter
get
that
priced out.
market.
Yeah. Yeah.
Get priced out. So what I'm saying is I think we got 18, 24, 36 month run here where we're going to see this inventory demand disjointment is here for a while.
Yeah.
And so, but it will normalize. Transactional volume will go down. So make sure you're saving a little more over the next 18 to 24 months.
Speaking
Maybe
of the
then you
savings rate, yeah, savings rate
speaking of,
because of real estate agents who
yeah,
listen to Keith.
I wish that were true. I hope and pray that for my people that that's true, but I'm not sure about that one. But there's room now to make, we're going to make some hay while the sun is shining. And that's great. We're going to
Yeah.
see some downward compression on the buy side over time. When that happens, transactional volume will go down. So save a little bit for a rainy day.
All right. Cool. Hey man, thanks for doing this. I
Yep,
hope for
yep.
the listener. I mean, normally talking like economics and inventory and like
Boring.
interest rate
Yeah.
is like, but
Yeah.
hopefully
This might
this was less.
hopefully this isn't the worst listen
Yeah,
to podcast
exactly.
I've ever done.
Just
And if people
slightly
dig it,
boring. Yeah,
yeah,
just
yeah,
slightly
yeah,
boring.
yeah. At least we
Hopefully.
didn't agree on everything. Then it'd be super boring. But yeah, if they like it, let's do it again sometime.
Yeah, the thing is, it's not like we have any data to really disagree on. You know, it's just, I
Yeah,
feel like at this point, it's like the data is what the data is. It's just
yeah.
what
How
the
you
future
interpret it,
holds. Who
and
knows? Yeah.
who
Yeah.
knows? Who
All
knows?
right.
Yeah.
Hey,
All right, brother.
if anybody wants to get a hold of you, where do you have Twitter? Like, where do they find you?
I don't. I tried Twitter for a while, and
Yeah.
it just wasn't for me. I don't know. If you search me, here, Keith at nexthome.com. Shoot me an
There you
email if
go.
you want to tell me I'm an idiot. No
Right.
problem. I'm sure if you search me on Insta or Facebook, you could track me down. I'm not hard to find.
Awesome.
But the easiest way is just shoot me an email. I got no problem.
Awesome. All right, man. Hey, thanks very much for doing this.
Good to talk to you.
All
Let's
right.
debate soon in person with Beverage.
Indeed.
All right. Talk to you later.
Indeed. All right. Bye.